back to your question. So here's the issue. When do we pay the price for the monetary policy we've had the last 8 years, particularly the last 3 years? And so, I'm not great enough to tell you it's 3 months away, 6 months away, but I'll tell you what I was saying at the end of last year when it wasn't on anybody's radar screen, and they kind of looked at me weird. And I said, when you really need to pay attention for when interest rates are going to rise is when the marketplace realizes that Chairman Bernanke is going away next summer. And everybody looked at me like, he's going away? Where's he going? He has maximum retirement. He's 65. He served the most number of terms he can. See, he was a governor on the Fed before he became chairman. He was 8 years as a governor. He served his maximum time. So Obama would have to ask him to stay and then go to the Congress and ask them to agree to let him stay beyond what has been the agreed-upon maximum retirement. And so Obama's already said, no, he's overstayed his welcome, just like the FBI director. So he's gone, right? And so what happened, literally, it was the day before the FOMC meeting, June 24th. Obama says, yeah, he's overstayed. So I was actually briefing Bernanke and them right before that FOMC meeting and before I went to our Dallas Industrial Conference. And so this broke, and I'm dealing with the FDIC and the Fed and all the regulatory community and all the deputies. And I can tell you, I've known Bernanke a long time. He's a pretty calm person, pretty introverted. Nothing ruffles his feathers. He was Major French turned off. He was very upset by it. And I guarantee you the lack of tempered language in that FOMC statement was affected by what was stated the day before. He wanted to basically be able to try to negotiate the start of this quantitative easing and deal with it on his terms and then say, I'm going to step out. You've got good hands here. Janet Yellen, who's here from the San Francisco Fed, she's the yin of Bernanke's yang. They're in lockstep on policy. And if you really think, here's where the Fed is terrible on communication. So they've said we're going to potentially limit our monthly bond purchases from $85 billion to $65 billion, right? Take $85 billion times 12. What is that? It's a little over $1 trillion. Okay. We've been running $1 trillion deficits, and Bernanke's been buying it. Now, the Fed doesn't produce anything, right? So how does it do it? It prints money. Okay, the world knows this. Money supply is going up. Okay, so he says, now I'm going to drop it to $65 billion. And everybody panicked. Oh, my God, this is going to disrupt the bond market. Well, what have we just been told in the last week? Because of the increase in payroll taxes and the budget deal that was done at the end of the year in January, that we're running less of a deficit, right? We're running about $800 billion. $750, $800 billion. Take 65 times 12. What is it? Around $780 billion. All he's doing is saying I'm going to quit buying bonds at the level of a $1 trillion deficit, and I'm only going to buy bonds at the level of an $800 billion deficit. There's no change. He's basically said nothing, right? But the market is like, holy crap, we thought you were telling us into 2014, 2015 you weren't going to make any changes. And my point was he isn't going to be around to keep that commitment. It's going to be someone else's. And so what happens is interest rates never just move up gradually, and they never just go down gradually, do they? They do this. So be prepared. It's going to do this. And my feeling is that day of reckoning comes sometime next year. The market is already pricing in that they want to be ahead of that. That's why they've moved rates up basically 100 basis points, because they know if the Fed starts at 25 or 50, right, probably start at 25, there's at least 4 or 5 of those to go, and they'll probably jump again to get ahead of that. So the bond market is going to stay ahead of this from here forward. And I think any hints, and when Bernanke goes, who that appointment is, and it's not only Bernanke, but the appointments, there'll be 2 new governors that'll be appointed, and you have a rotation of voting Fed presidents. Not all 12 Fed presidents serve as voting members. They rotate. New York Fed's the only one that has a always constant voting member. And already this year we've seen 2 new members rotate on. Jim Bullard from the St. Louis Fed and Esther George from the Kansas City Fed. These are the Tom Honigs of the world recreated that want to end large banks and completely end quantitative easing. And so the Fed is 1 vote away today. If you look at the latest meeting minutes, 1 vote away from completely ending quantitative easing. The Fed's 1 vote away. So Bernanke goes. If the appointment isn't there, 2 governor appointments. You've got the Atlanta Fed president, Dennis Lockhart, that rotates out this year. He's been lockstep with Bernanke. If they rotate that to Richmond, Jeff Lacker, who's not, he's for pulling it, we're done. So The rest of the world sees the inflationary. If you look at the rest of the world, they're not buying our bonds at the same level. What is China doing with its dollars? It's buying assets. Look at their sovereign wealth fund. They're sucking everything up that they can. They can go and build a canal in Nicaragua to have their own canal. $50 billion. So what? It'll cost $100 billion if I wait and don't build it today. Your exact point on the drinks. So I think the day of reckoning is very close at hand. You cannot... The Fed has never been in these positions. We've never had a central bank that's got almost $4 trillion on its balance sheet, produces nothing, keeps printing money, right? And the only thing that saves our dollar and our 10-year treasury is when we have a big crisis in Egypt or Europe, right? So if you want to keep the thing in check, just pray for lots of crises around the world, right? But I think at some point we really do pay the day of reckoning. And I think we're close. I think next year really is the year it worries the dickens out of me. And every time we have a change in the central bank composition, we always have volatility in interest rate policy.